Stocks finished the week on a little bit of a sour note, but again, not very much. So I'm going to break down in today's video why, like how bearish we were and what should we expect next week because of that. Are we heading into a period of softness? How weak should we expect to be? We're going to break all that down in today's video. We'll look at there's some surprising intermarket moves today. In fact, there was a surprising combination of intermarket moves. We'll break that down, kind of what that means, and they also have a very important aspect into our expectations going forward. We'll look at the sector rotation. Not the best sector rotation this week. I'll tell you why and show you that. And then we'll just take a look at, okay, what kind of levels, as we kind of expect the market to continue to go up, what kind of levels do we need to see us break before we start to say, okay, this weakness wasn't just weakness. So we'll talk about all of that in today's video. I also break down like why the market outlook video is no longer free, why we put it behind the paywall on our Market Scholars website for at least for our foundation members, and break down our different pricing. And so I kind of explain my reasoning. Yes, today's video is free for Fridays, but I kind of explain the reason why it's no longer free, even though I've been doing it for free for 15 years. So we'll break that down here at the beginning of the video. As well as kind of, show you some of the new features that we've added to that tier, to that foundation tier. So let's go ahead and get started. All right, today is Friday, July 11th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. That will notify you when the next videos are posted. Hit that like button down there. Comment on anything that stood out to you today. Join our website at MarketScholars.com. There's a link. You can see the link up there at the top. Subscribe to our site for free. That allows you to see the Market Outlook post every day and see that Market Outlook preview video. So you can do that just for our basic subscription. You can also see a link to that down in the comment, the description, the YouTube description down below. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're not watching on our blog, make sure you go check it out. It's underneath Market Outlook. You can see our video archives. Go to today's blog post. There's a lot more to this than just the videos. You can see there's a full table of contents of different categories, as well as the trade idea for today. The different categories of trades that we do. There's the link that takes you to the comment section. And there's a lot that you can check out here. And like I said, share it with other people right above the Market Outlook. There's the links that you can share with other people. But check that out. Go to the video there. I also wanted to bring up, again, the fact that, why did I put the Market Outlook video behind the paywall? I talked about this yesterday for all of our members. And since this is a public video today, I'll bring this up again. Again, I've been doing Market Outlook videos for years and years and years, like probably about 15 years. I've been doing at least 8 years for Market Scholars, and probably about another 7 or 8 years before that for Investors and TD Ameritrade under the Market Forecast moniker. So I've been doing this for a long, long time, and I've been doing it for free for a very long time. But what we've done now is we've added this live trade tracker to the bottom here of the Market Outlook live video. So when you're a foundation member or higher, you get access to our Market Outlook live. There's all the archives, and then down at the bottom you see there's a trade tracker. You can click on that, expand. It pulls up a big old trading journal of all the trades we've done throughout the year. And if you were to add up all the how we've done throughout this year, then you can see here that, and this includes this as of yesterday when I did this, the total returns, including all the open positions that we haven't closed yet, but the total returns are equal almost $14,000 per year. Now, to kind of give you an idea, if I scroll down here to the bottom, we on all of our directional trades, we take $500 per risk per trade. On the higher probability trades like short verticals or condors, we place $1,000 per risk on those trades. And so at any given time, I probably have, on average, over the course of this first 6 months, I've had about $11,000, and that's kind of where I'm at right now. And that's the highest I've had all year. We've had more positions going now than I've had all year long because everything's been going pretty well. I mean that's like 9,000 of this. You can see right here, 9,600 of it is trades that have already closed, and I've got over $4,000 worth of gains so far in the open trades. So that's the idea. It's like, okay, well, it only costs, I'm not charging a lot. I'm only charging $299 for the course of a year, or $29 a month, but $299 a year. And you can see all the pricing here when you go to the pricing comparison page up here at the top. But considering that, we're up almost $14,000 in 6 months, to pay $299 for a year is not that big of a cost. And I was giving this away. This is only 6 months, number one. And number two, I was giving this away for free before. But I didn't feel like that was fair anymore to our elite subscribers, who this is how much they pay. They also get access, everybody, all of our subscribers. So you can see our premium level. These are all yearly subscriptions. But you can also see how they kind of pale in comparison to, again, what you make. Now, granted, as an elite subscriber, you get way more than just one market outlook trade a day, and that's all this is coming from. Right? We have 9 trading rooms between Brandon and myself. You have one Q&A session where I can take a look at the trades you want me to, and ask about any trades you want me to look at. But there's a lot of value just in the market outlook video itself. I mean, like I said, there's $14,000 worth of value in the last 6 months. And just the market outlook video itself, by itself. And so I'm just asking for a small cost so that I spend a lot of time making these videos. So this is a small cost compared to the value. This is a small cost to pay for me to continue to make these videos. And, again, it just reminds our elite subscribers that, in fact, you can pay for it. And in fact, one of our elite subscribers said this is what they said, that they paid just for the first 6 months this year. They have covered, they've been a elite subscriber since the very beginning, since 2018. So that's 3 different 3-year subscriptions. He's covered the cost of all 3 of those with what he's made in the first 6 months. And he didn't take all the trades. He kind of cherry picked some of the trades there from a long positions only, but yeah, because we do lots of different types of trades in the market outlook. So I just wanted to point that out before we get into the video as to why I'm placing. And if you want that, right, if you want these videos, the full versions and the trade idea and the trade tracker that we have on the market outlook page down here, if you want all of that, then just go to our pricing page up here at the top. Scroll down until you get to the foundation. You just click here, see pricing plans. Scroll down to our foundation, and you can subscribe either $29 a month there or $299 a year there. If you have any questions, this will pop up. Just click on that down in the bottom right corner. And like I said, the cost. If you're interested in all of our trading rooms, the benefit you get out of this will more than cover the cost of any of these other subscriptions. It really puts the cost of these, which looks like a lot of money, but it puts it in perspective when you figure out, again, and that's, again, if you put $500 per risk or $11,000 total capital at risk at any given time from month to month. So unlock your access now. You can just do it right now while you're watching, and from now on, get access to all the videos going forward for the rest of the last 6 months of this year, for the next year, and then again, if you do the elite, you get it for 3 years, right? And no change in cost, because the cost, you can see there's, I have a little bit of incentive to change the cost here at some point in time, but right now we don't. If you lock it in for 3 years, then you lock it in throughout any cost changes, and you get access to all 3 years of market outlook videos, plus all of the trading rooms, right? There's 9 application-based trading rooms, as well as our CMT, and all of our tools that we give all of our premium subscribers as well. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we were down today 1/3% on the S&P. The near-term line came down, momentum line came down, but again, we talked about that. We talked about, again, this minor red flag that the near-term line got into the upper reversal zone without the momentum line. And last night we said, okay, that probably means that we'll probably have a short-lived near-term rally. And, that looks like that may be the case here with already out of the reversal zone. That doesn't mean it's not bullish anymore, because it's actually still in bullish territory. The momentum line's down in bearish territory, but it's not oversold. In fact, it hasn't been oversold since expiration, since the June expiration. It's been, it's gotten close a few times, but it's bounced up every time since. We're still more than 3% or nearly 3% above the moving average at the 2.5% mark. So we are hardly like, dropping here, breaking any kind of support or anything, right? So it's a pretty clear small decline. Interestingly enough, like this week we've dropped 3 days out of the 5. And then if you look at where we felt like last week, remember we closed with an overbought cluster on Thursday, and we were actually lower. We closed there at 62.79. We dropped 20 points. Now it's a small 20 points, but it kind of goes to show, like, I mean, this is a down week, and this is like, we had a down week then, you would have never really felt it really, even though again we started the week negative and finished the week negative with a small little pop in between. So that's what the S&P is looking like. Let's look at the NASDAQ 100. Whoops, if I can hit the right keys. Again, very similar. The near-term line, remember, never did get above the 80th percentile. It pulled back. It is out of bullish territory. It still hasn't dropped in the bearish territory yet. So technically still the same. I mean, we've been on one near-term rally since options expiration, and we're only a week away from the next options expiration. So it's typical for a near-term rally to last 7 to 12 trading sessions. So that's, about a week and a half to 12, which is just over 2. So we've gone now 3 weeks, and so it's, we're pretty mature in the near-term run. So it wouldn't be surprising to have a little bit of a dip on the near-term line. The momentum line's down, but in bearish territory, but not down much, not oversold. So, there's a good chance that we could have a little bit of a slide going in the next week. The Dow Jones, the near-term line had crossed 40 and 60, but has already dropped back below 60. So, just like that, one day we crossed below 60, and the momentum line is not only lower than the near-term line, but it's below 20. So, again, a little bit of a suggestion or idea that, we might have a little bit of weakness going into next week from what the market forecast is suggesting. Remember, the intermediate line, even though on the Dow it looks like it's the lowest, it's still, even though it's falling, and it's falling quite a bit this week, it's still easily in the upper reversal zone, and it's still easily above the market sentiment line. So again, no change in trend here anytime soon for now. That can change, but for now, a little bit more bearishness on the Russell, and this is a little bit of a red flag. The Russell, remember, had such a great week. 3 straight days. We had some good outperformance there, some good outperformance here. But when it goes south, it goes south, and it went south. It wasn't so bad on Monday, but today, even though it looks like a smaller loss today, the market forecast looks worse because the near-term line, again, dropping below 60 and 50. The momentum line's lower than the near-term line, and it's below 20. It's not only below 20, it's at extreme lows. Now remember, the NASDAQ tends to do this, right? It tends to get more extremes. Last time we had a move like this was here on June 11th, and we had a couple more days of decline. So, so there's, I think that there's a good chance that we, start off next week at a little bit of a sour note. At least that's what the technical picture and the market forecast picture is telling us, and especially is what the Russell 2000 is telling us after it's been the big leader for so long, but not necessarily the case today, and maybe leading some, again, in the weakness category. Let's go back to the S&P and take a look at the weekly market forecast chart, since it is a Friday. And take a look at the weekly chart here. And again, remember, we got the cluster last week. We finished very strong, very high. So not surprising, we get a little bit of a decline. The momentum line down, but not oversold. So we don't have a bullish intermediate confirmation signal. And the near-term line is still strongly bullish. So again, no concern here. A little bit of a dip, but not much of one. And even if we get a little bit of early weakness next week, it might just be a near-term decline and nothing more than that. We might already be bouncing back up off of that near-term low by late next week, is what I would expect. Here's the Russell 2000, which remember was playing catch-up. It just got that kind of bear tag type pattern here like this. And we really built on it last week and broke out. And then now, again, just a small little pause, but the intermediate lines cross above the market sentiment. It's in bullish territory. So again, any weakness we get, I think, would be very temporary based off of these charts. If I look at the weekly chart here, we did finish slightly above the Hakinashi close. So we will start off next week, again, barring a big opening gap to the downside Monday. We should start off with a pretty good bullish candle next week. The candle size is small. It's going to be below the average. So again, there's going to be some, but you can see during these, when the size of the candle down here at the bottom was below its average this whole time, we still went up, right? So just because we're going to have smaller bodies doesn't mean we're going to like reverse, right? Well, we could still stay above the 10-week exponential. I mean, we're still easily above the 10-week, and the PPO is rising, getting closer and to that 5% mark, which is an important mark to not only get above, but and stay above and be really trending. Whereas breaking below it tends to be a sign of correction when you've been above it for as long as for a good period of time. Let's take a look at the 3 green arrows. So we do have a red arrow now on the stochastics and the MACD. Same thing with the Dow. The Nasdaq got one yesterday. The Russell's still relatively bullish, even though it was the most bearish today. It held up on the MACDs, so we didn't get the green arrow, a red arrow. But again, we don't have 3 red arrows, so 1 red arrow does not concern anything. 2 red arrows does not concern, even though we're not really close to 2. It's getting that 3rd red arrow, and even that's not an issue until you build on it, right, to the downside. Because as you can see with the Dow, when you're bullish in a bullish trend, 3 red arrows tends to be a really good bullish signal, like a really good buying signal. Ultimately leads to 3 greens, and you're moving back up to the upside. Sometimes you don't get the 3 greens, which is why, again, 3 reds. Again, it can be a trend. It's kind of an inflection point. It can either change the trend or be a really good, buy the dip signal and maintain what, the bullish trend that you currently have going. Let's take a look now at the 2-line version. And again, like today's weakness still did not get you below the 8 days. So we might flirt with the 17 early next week. Maybe is what I expect. The MACD, like I said, is barely below the moving average. Remember, they're both at pretty high levels at 1% there on the PPO. The stochastics also is below its average, but still both are very high levels. So, no issues there. The DMI, we're still above 30 on the positive indicator, still well below 20 on the negative. Your ADX is above 25, so you have dark green shading. So we're still, the trend is still strongly bullish. The RSI and the CCI are still at strong bullish levels, well above 60, easily above 0 there. So that's not the issue. The Ichimoku cloud, again, we have some weakness, but it hasn't, we're not below the green line. We don't really have to worry about the trend ending until you get below the blue line. And we're not close to that. The rate of change is clearly positive. So that's a nice development there. The weekly Ichimoku cloud has turned green again, and we have intermediate strength trend on the weekly chart. So that's a good sign for the S&P. And you can see the 26-week, which is a 6-month rate of change, which had been negative during the correction, has now rebounded in a really nice, good way there. Let's take a look at the Bollinger Bands and the Keltner channels. We are still in the upper quartile, at least flirting with the upper quartile of an increasing bandwidth. Finally, we closed below the Keltner channel, but barely. So, again, don't be surprised if we don't flirt with this green line. But as long as we just flirt with the green line and bounce, and the bands stay outside the Keltner channels, then we're fine. There might be a little bit of weakness coming off of this momentum, but again, we'll see. When and if the weakness does come, we'll gauge just how strong that weakness is and whether it has legs to it or not. And really, remember, if it has any legs, the first expectation is that all it does is produce a 5% pullback, and then we know after getting a 5% pullback, we tend to get a double-digit green tag coming after. I mean, the last 5% pullback has produced this 20% green tag. So it won't be a bad thing to get a 5% pullback. We might go back below the old highs, and but we'll probably stay above the 23% retracement line and be just fine. So it won't be a bad thing, and we'll probably get another double-digit green tag coming after. But until then, I'm not sure if this pullback will turn into that or just be a near-term decline down to those levels I talked to you about, which I think is probably the more likely scenario because we don't really have a catalyst yet to increase the volatility to the downside. If you take a look here at the trading or the intraday moves, we did close above, even with a late little drop there, we did close above yesterday's low, which again is another sign that we're not that bearish, right? We did get a lower high and a lower low, but we closed a lot closer to the high of the day, and we closed, we filled in the gap, and we closed above yesterday's low. So it's going to be a much tighter weekly range because there's only a slightly higher high, and the weekly low will move up slightly to right there. But the 4-week range is going to stay here for a while, barring a new high. The 4-week range will stay. The low point will probably end up a rune indicator here on the low will probably go down to 0, which means that this will probably go all the way over here before we have to start worrying about a new 4-week low point. And you can see, but once that's not going to be till after next week. It'll be the week after expiration. Then you can see it's going to start moving up pretty rapidly again. So like last time we talked about that and we started getting new highs. And so, again, that can happen again. It could also, break down to the low point, but we'll watch. We'll keep our eyes on that. And, we expect the market to maintain this bullish momentum until it doesn't. The trading range is obviously pretty small, has been. The volume, is pretty small. So that continues to weigh on the relative ATR, which is now below 0.9. So really, really, bullish from that perspective. And now the volume is starting to roll over, and there's plenty of downside to that volume. So that's why I think we're not that close to any kind of significant weakness. Well, not while there's so much, volume, and while the money flow remains, very strong. Like you can see, the oscillator is at strong bullish levels. So we have very, very strong money flow, and so it's not really an issue. We don't have to worry about that yet until we start to see some kind of breakdown here. Obviously, that's not the case. The VIX rebounded a little bit today, back above 16, but still below 0.85. The VVIX ramped up a little bit. It got up, to 93, so it can't get down below 90. But you see the correlation did drop below 50%. Again, in the past, it has prompted, a couple of near-term declines and a little bit of an increase in volatility. So I really wouldn't be surprised if we don't get a jump towards 20 on the VIX in the next little bit. And most likely nothing more than that. But according to what we're seeing from the VVIX, that it seems like that's a likely outcome here in the near future. All right, now let's talk about what's driving a lot of the price action today. So let's go to first the asset class comparison chart. Well, kind of start off there and just look at today first. Commodities, big time move up to the upside, and that's with the dollar being bullish. So this is not a common pattern. See the dollar up. Yields were up, of course, and commodities. That was our three-headed monster in 2022. Yields higher, dollar higher, commodities higher, and they really took off today. Gold took off. You can see a big time jump there. In fact, let's take a look at the commodity 12 grid. Crude oil was up in a big chunk today, coming off of that low point. But look at gold breaking back above the moving average. Here, let's put Bitcoin in that place. Look at Bitcoin continuing to push higher through that cluster. Silver got a cluster today. Look at that big jump higher in silver. Copper a little bit down, but that makes sense because it's been so bullish over the past few days. It's had a really, really good week. All your soft commodities are all bearish today. Every one of these down here pushing to the downside. But gas, heating oil, gasoline, crude. So whether it's those kind of commodities or metals, including Bitcoin here, which is not technically a metal, but kind of gets lumped in there as a alternative currency to the U.S. dollar, everything. So you think, okay, well that probably means that the dollar fell today. Well, that wasn't necessarily the case. The dollar actually rose today. It's been rising, right? We got above the 17-day moving average. You can see the MACD is above its moving average and rising, so Stochastic's almost out of bearish territory. Now, granted, it's not like taking off. It's not breaking out in the least bit, but it's also not dropping anymore. It's up 4 out of the 5 days this week. It's had a good bullish week here. So, a little surprising to see metals do so well on a day that the dollar is actually higher and not dropping sharply. Yields jump back above the moving average. You can see it got above there earlier than a week before it got up to 4.41 on Tuesday before the drop on Wednesday. Rebound right back up, finishing at 4.42%. So a big time jump to the upside, 7 basis points. Again, going from the bottom of the 4.25% to 4.5% range to the top of that range, because we're getting really close to 4.5%. But again, everything's okay as long as we stay. Like, I think it's actually probably more of a bullish sign for the markets, for risk appetite in general, that yields are not breaking that 4.25%. Because if they're breaking that level, then the 10-year yield starts to force the Fed to act. And it's not because the economy is doing well, right? It's, something's happening, and that's what, that's why the bond market is drawing a lot of interest. That's what makes yields go down. There's a lot of buying demand for bonds. With yields rising and inflation relatively tame, that's, again, when yields and stocks kind of move together to the upside, that kind of means that inflation is not necessarily a concern. And so now we're kind of back to more of a bullish scenario. And again, barring a big, huge breakout above 4.5%, it's probably not a bad thing, because of course, what that ultimately means, let's see if I can find it here. What that ultimately means here is that rate cut odds are coming down. And remember, I don't know how much I have to beat this drum, but the market does not want rate cuts. It just doesn't. Like, maybe one or two, but really it doesn't want even that. It's more bullish for the markets to not have rate cuts. And so, like, right now, the odds of those cuts coming, obviously we're not going to get a cut in July. You can see there's no 93% chance there's going to be no cut in July. So that's by the end of the month. September is the live meeting. And now the odds, went from under 30 to back over 35%. That's still a high probability of a cut. It's just not as high, right? It's just barely over 60%, which is what the high probability is, threshold is. So the odds of no cut in September continue to creep up, and the more that gets to 100, in my opinion, the more bullish that is for the markets. And so, and your 2-year yield, you can see, is jumping up today. I think that's kind of telling us that right now that's kind of where the market's heading. It's heading towards this anticipation of no cut. And so, what will end up happening is this will ramp back up to 4.25% most likely. And so that will kind of confirm whether or not that happens. And if that does happen, if the 2-year yield does start to ramp up, towards where the 10-year yield is not going to go up that much, because remember, it's going to be constrained. So what's going to happen is the yield spread here is most likely going to start to falter back down, right? Because if this breaks out to the upside, because the Fed is cutting rates, then we're in trouble. The market does not like a yield spread that's rising. It likes a high yield spread, but it doesn't like a rising yield spread. What it really likes is a falling yield spread, and especially a negative, an inverted yield spread. That's really what the market really likes to see. And so I think we got some resistance here on this spread. It most likely will not break out, again, barring a significant rate cut campaign. Because again, that's what happens during rate cut campaigns, is the yield spread rises and the market doesn't like that. So, that's, and the only way that happens is if the market needs it. And obviously with everything at all-time highs right now, the market obviously doesn't need it. Doesn't need the cuts. So I think what's going to end up happening is you'll get more and more, sorry, I guess it was on this chart here. This will ramp up, but it probably won't break out, right? It'll probably get up to, to these old highs, work its way up there, and then probably stall. And that's okay. Like, that's, as long as we're in this range, that's bullish for equities. It's when we break out of either side, if it breaks out to the upside, that means inflation is going to start, ramping up. Expectations are going to ramp up again, and we have to have rate hike odds start coming out. If we break down to the downside, then there's a reason, and that's, troubling when the 10-year yield is yielding less than the overnight rate is yielding. So the Fed's got to cut rates, and that's a problem. And so we don't have that issue, and we're still stuck in the middle, and it's a little bit of a rise, but that's kind of nothing more than that. The rise is simply just, hey, we don't have economic problems. We don't have it in, we're not, the growth, economic growth isn't dropping too much that we have to concern ourselves with. And so we rebounded off of a kind of a cyclical low point and nothing more than that. But those commodities, I mean, that's the big thing is, and remember, commodities rebounding is something we want to see too. When commodity markets are not, when they're below, in this case, a 200-day moving average, like they've been, like we had such a good run in 2021 and 2021, we were bullish, and then in 2022, as the markets were in correction mode, commodities were taking off like a rocket, and then they started to decline, and the equities were doing bullish. But commodities were declining. Well, we've been below that 200-day for so long. It looks like we're starting to ramp back up above the 200-day, which at first glance would be, a sign of weakness for the markets, as we saw today. Rising dollar, rising yields, rising commodities, together as a group together tends to weigh on risk appetite. And we saw that. A little bit of a weighing on risk appetite. So I see some potential for all three of those to kind of rise here in the very short term. And that could very well put some pressure on things. But eventually the commodity rise will be kind of a function of, and I think the dollar will ultimately turn lower. Commodities will continue to rise, and that will ultimately be a function of strong economic growth expectations leading into strong earnings expectations and so forth, and into a bullish market. So I like that pattern there. If you take a look at the some of the major markets, we talked about the developed markets struggling. Well, they struggled again. Japan's got dark pink shading and a red line. Germany's dropping closer. Italy is dropping. India's got a bull tag, light pink shading, and a yellow line. France, dropped again. UK dropped this time. It didn't drop yesterday. So it seems like international equities, which have been such outperformers for most of the year, at least from year to date, right? The international equities kind of held their value really well during the decline, and as a result, they have an outperformance for the year because they're not outperforming off of the April lows. The U.S. equities are, even with the weak dollar, U.S. equities are outperforming off the lows. But because of, from the February high going through the low and back up, they are outperforming because they held their value better during the decline, during all the tariff mess. And you can see they're all converging and they're all flattening out. And, I think there's going to be some relative weakness here. There already has been over the last few weeks, but I expect there will continue to be, well, you can see it here on the rotation graph. Let's pull up the relative rotation graph here really quick, and I can visualize that for you. And it's going to be right here. Oops. Nope. Here. There we go. So let's take a look here at just EFA and EEM. Save changes. So you can see that there's already been some underperformance, right? They've been outperforming during most of this run, like during the declines. Let's see here. Let's fit. There we go. Max. There we go. So you can see during the decline they outperformed. They held their value better during the decline. But as we got to the lows and bouncing, they started to underperform. And now during the rally to the upside, they've just been mostly laggards, right? They're moving over in this direction. You see that in the weekly chart as well. Like they're moving down to the left right now. They were up to the right while we were bearish, and then now that we're bullish, they're moving down to the left. And I expect that will, as long as we're bullish, that will most likely continue to be the case. Let's take a look at the sectors and how they performed today, and let's zoom in on just today. Energy being our big winner, which again is not a good sign, right? We want technology to be the big winner, and to other lesser degree, communication services and discretionary. But today, I mean, for a good chunk of the day, utilities and real estate and staples were all laggards. But then those two really took off and outperformed the market, and staples outperformed briefly before a late little pullback. Financials struggling as we head into big earnings season, as the beginning of earnings season with those financial stocks next week. Materials, after a strong start to the week, pulling back. In fact, let's zoom out to the beginning of the week. Remember, materials had a very good, oh shoot, I forgot it. Because of the holiday, you have to go all the way back to Thursday. But you can see materials had a very good run, early, kind of in midweek, before pulling back here at the end of the week. Energy maintained. They stayed strong throughout most of this, staying up 2.5%. Utilities and industrials both had a couple of days where they led the markets. They held up, and there's your technology holding up as well. The communication services really lagging the past few days. In fact, let's just go to, we'll go to Tuesday going forward. And then again, there's what's happening. There's the strength in materials and energy. But these are not sectors we want to be leading, right? There's a good healthy mix here of some sectors outperforming the market, some sectors underperforming. But the reality is we want the XLK, XLC, and XLY to be not just above the black line, the S&P, but also above most of these others. When these other sectors outperform the markets, that ratio tends to be negatively correlated with the market. So when they're outperforming, it's not because the markets are that bullish. I mean, the market was up 0.5% from Monday's close, but we know that this week they weren't very bullish, and we see that reflected in the sector rotation. And again, even today with the breadth coming back down, because we saw the Russell 2000 really underperform today. So we'll see how much that bleeds into next week. I think, again, we're set up for rotation into some weakness here, of not just from a technical standpoint, but you can see it as well in how these commodities are behaving as safety trades, and how at least these metals are behaving as safety trades, and how the breadth is starting to soften a little bit. Remember, breadth tends to lead price down to the downside. If you take a look at the advancers versus decliners here, let's see if I can see. There it is. And let's refresh that page so we can see the full. You can see decliners really getting its butt kicked. Again, 2,800. So we didn't have 10% of this is 283. So we didn't really have extreme breadth to the downside. And the same thing here. We kind of had 3-to-1, but again, it wasn't necessarily extreme decline, because again, 10%'s 4.470, and we're well above that from a share volume standpoint. So it was a strong down day, but it wasn't a trend changing down day, like a big sentiment change from one direction to the other. All right, and that brings us to our trade idea of the day. Let's take a look at ServiceNow. Now remember, I placed this trade already before the market closed, during the Market Outlook Live, and on the Market Outlook Live session. We do that 3:30 Eastern time every day before the market closes. Every day I'm here, obviously, before the market closes. We manage all the old Market Outlook trades, see whether we should stay in them or not, or get out of them. So we manage all of those, and we keep track of all those trades from throughout the year at the bottom of the Market Outlook Live page in our Market Outlook Live trade tracker. So that's kind of where I told you earlier that where the results come from, and obviously the benefits of being at least a foundation member. At the very least, a foundation member, is you get access to not only these videos. Again, this is free for the weekend, but you get access to the full version of the Market Outlook videos every day. And then you also get access to the Market Outlook Live, right, where we make the trades, and then we track and manage and track the trades. All right, so with that said, today's trades on ServiceNow, dark pink shading and a red line on the market forecast chart. You can see the short-term sentiment is very bearish, intermediate line crossing below the chart's midpoint, headed towards bearish territory, forming a pretty bearish peak here. The intermediate line never did get in the reversal zone, never crossed back above the market sentiment, and we're back to rolling over. Again, dark pink shading and a red line. If you look at the weekly chart for this, you can see we got a transition candle. That transition candle happens to be a bearish candle, and then you can see the red arrow, which means we close below the 10-week. The PPO is falling back down. The size of the candles, dropping, and will be relatively large tomorrow, or excuse me, next week. When you look at the 3 green arrow chart, not surprisingly, we have 3 red arrows. We got that yesterday, but we followed through in a couple strong days of volume the last couple of days. If you look at the 2-line version of this chart, you can see you're breaking back below the 200-day moving average, back below the point of control. There's not very much volume down below us until we get to the bottom of the value area and fill in this gap, which is now threatening. Or to fill in this post earnings gap there going into its earnings. MACD and stochastics rolling over to the downside. If you look at the DMI, let's look at the DMI here. You can see, we're well above 30 on the negative indicator, below, not quite below 20 yet on the positive indicator. We'll kind of keep our eyes on that. But the ADX is really low, starting to rise. So we had a situation where we didn't have a trend, and now it's starting to rise there. The RSI and the CCI, if we take a look at those, you can see below 40 in the RSI, well below 100 there on the CCI, below minus 200. So big trend change there. The Ichimoku cloud, if you take a look at the cloud, we're into a pretty large cloud. So that means that, it's really easy to fill in the cloud down to about 860 or so, especially considering we don't even have a bearish trend yet. According to the trend quality and noise balance indicators down at the bottom. Now you look at the Bollinger bandwidth. The bandwidth got really low. Here it's pulled up. Got really low during that sideways move. We started to break out to the upside. Fake out, which remember is more bearish than a regular breakout, than a regular resistance holding. We tried to break out. We failed. And then now we're breaking down to the downside. Breaking below the lower band. Breaking below the Keltner channel. The momentum is turning south. It's not even negative yet, and then your bandwidth is rising and still at low levels. So there's some good opportunity here to be bearish, and we don't have very many bearish trades. We're very heavily bullish in our trades. So I decided to do a long put vertical spread, selling the 20 delta. So selling buying the 860, which is where the bottom of the cloud is, and selling the 840. So relatively aggressive, but within the range. If you look at where that Bollinger bandwidth is for the stock. You can see where the 811 is where 1 standard deviation is. That's where the bottom of the value area is. So it only has to get to 840, and we got a lot of flexibility here for timing. So I get good 3-to-1. We only did, it's a $20 wide spread. That's that's what the strikes give us. So you can only do the one contract and stay within the $500 like we like to do for directional trades. And you got a 3-to-1 reward to risk ratio. So again, very low risk. Remember, the risk is still the same on every trade we do, but what makes it low risk is how high the return is. Because sometimes you go for $100, sometimes you go for $750, sometimes you go for $1,000. And in this case, we're going for 3-to-1. So the bigger the reward, it makes the risk smaller, even though the risk is always around 500 because of how big the reward can be. So a good opportunity here, and a good opportunity to mix our little inventory of market outlook trades up a little bit with some bearish trades, just in case we start to get a little bit of a turnaround in the market itself. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. I want to see your comments, right? I want to see comments over the weekend. You can comment down here below the video. There's a link that takes you to the comment section at the bottom of the blog post. You can comment there. If you're watching this on Twitter, you can comment to today's market outlook tweet. If you're watching this on YouTube, you can comment on the YouTube video as well. You can comment. I'll reply to all your comments. You can comment on LinkedIn if you happen to be watching there. You can comment on Facebook if you're watching there. But I want to see what you think. What do you think about what the market's doing this week? What are you thinking about going into next week? What do you think about some of the things we talked about in the video? What stood out to you? What questions do you have? Post all those in the comment section. Remember to share the market outlook with anybody and everybody. That's free for the weekend. So you can share it and let everybody see kind of what they're getting. With the market outlook, it's obviously for our foundation members throughout the rest of the week. But share it, let other people see it. You can share it every day, even the market outlook previews that we do every other day of the week. But again, thank you. Subscribe to our YouTube channel, like and comment, and share it there. Follow us on social media accounts, Twitter, Facebook. Like us there as well. Let's get some likes on the Market Outlook tweet. It's really gone down to where there's hardly any likes on it. So, if you find these videos useful, let me know and hit that like button there on Twitter, on YouTube as well with that like button. Have a great rest of your weekend. Thank you for watching, and we'll see you all on Monday.